Welcome back to our monthly video commentary series, looking back at the month of April and what a wild ride it's been. Today is April 29th, so we're going to capture the most interesting graphs, trying to highlight the signal. There was a lot of noise, stuff coming out of mainstream media. The market was down almost 13%. It's rallied back to darn near even for the month, and this would be the greatest intra-month reversal in history if we were to somehow flip positive. We still have another day and a half of trading left, but it's certainly been a wild journey. And if you mixed investing in politics, if you were over your skis with risk, if you were staring at your phone or staring at the TV, monitoring every tick down, you might have made an emotional decision. But when we zoom out and look at the year to date on the S&P 500, we're down a little less than 6% as of this recording, which is hardly catastrophic. Let's get into the slides. So this is the last 30 days, and we've highlighted several asset classes that are important to our clients. Starting at the bottom, small cap value, the S&P 500, which again, as I've highlighted, is almost flat for the month. This is a long-term U.S. Treasury bond ETF, emerging markets here in purple, various types of bonds, short-term corporates here, short-term treasuries, intermediate-term corporates, intermediate-term treasuries. Tech actually flipped positive as of today, again, April 29th. And of course, foreign stocks, gold, Bitcoin, quietly having a very, very good month. So as you can see, it's been a tale of 2 months. So the reciprocal tariffs were announced about here. Market did not like that. The bottom really fell out of most every asset class. And since then, since the 90-day tariff pause, you've seen a pretty steady rally back for many equity asset classes. Of course, gold and Bitcoin tend to do well during currency instability, geopolitical instability, and they've really been a haven for many investors. And the other thing I wanted to highlight was bonds had a pretty steady journey throughout all of this. I know there's been a lot of nonsensical talk about the death of the dollar, the death of U.S. Treasuries. I'll get to that later, but certainly that is not the case when you look at the actual numbers. So bonds holding up well, gold doing extremely well, Bitcoin quietly having a really good month, and equities, despite the wild ride, measured by the S&P 500, almost flat on the month. So given this wild journey, a lot of investors are wondering what happens next, and no one knows what happens next, but we can look at history, which is a consistent theme for us at Pure Portfolios. So what we've captured here is when the S&P 500 is down over 10%, hitting a month low, an intra-month low, and rallies back at least 5%, how does the next month look? How does the next 3 months look? 6 months? And next year? It's happened, I don't know, a dozen times over the past 60 some odd years. I think this is post-World War II. And let's find where we're currently at. So at its low, the S&P was off a little more than 11%, rallied back about 10%. And this was as of last Friday, I believe. So down 2% as of last Friday's close. Going forward, we don't know what happens, but we can look at these other instances to start to frame our potential outcomes. And you can see over the next month, over the next 3 months, you can get some ugly, crooked numbers still. But as you get further out over the next 6 months, over the next 12 months, the numbers start to look a bit better. And there are exceptions. So this is the great financial crisis here, where the next year was down 40%. And then this is the latter part of the financial crisis where you still had these ugly numbers. But if you exclude financial crises, the numbers are quite good. You can see the average return over the following year when you get these large whipsaws intra-month is about 11%, a median return of about 13%. So again, I'm not saying this is going to happen in this latest instance, but the further we go out over 6 months, over the next year, these numbers tend to smooth out and they are positive. Heading into 2025, we said U.S. equities were massively overvalued. And what that means is there's just not a lot of margin of safety. There's little margin for error. And it doesn't take much for someone to flick a domino in the most frothy corners of the market, the riskiest corners of the market, the most overvalued corners of the market tend to unwind. And in our opinion, that's really what's happened with U.S. large cap stocks and big tech stocks. When you zoom out and look at the investment universe, it does extend beyond the S&P 500. I know that's hard to believe because the S&P 500 has worked great over the past decade plus. A lot of investors tend to overweight what just happened. And that means U.S. equities, namely U.S. large caps and big tech, have been overwhelmingly in favor. Foreign stocks, emerging markets have been overwhelmingly out of favor. That's all flipped this year. And many of these other countries, whether you're talking emerging markets or foreign stocks, were dirt cheap. So when we talk about little margin for error, there was a big margin for error for a lot of these countries because the valuation was the hedge, meaning a lot of these countries were so cheap, it didn't take much to go right for those future returns to be better. So when we stack up country returns since the election, since the tariff announcement, the U.S. market is the 5th worst performing market in the world. And you can see most other countries, including those that are in the crosshairs of our trade ear, are doing quite well. So you look at Canada is positive. Mexico's had a really good rally lately. You can see in April up about 10%. Many of the European nations are having solid years as well. Even China, since Trump took office, up 12%. A little rougher sledding here in April, but still positive on the year. So since the election, the average country is up about 7%. Again, the S&P's down about 6%. Post-tariff announcement, still positive, and the S&P has clawed back a bit, but down about 12% at its worst. So to us, this is more of a valuation story. This is more of a story between frothy U.S. companies heading into the year, which we wrote about multiple times in our blog, and just a better setup from a risk-return standpoint for emerging and foreign stocks. So a lot of folks have asked, are we going to get a recession? And a lot of the soft survey data, when the government is calling people on the phone, asking them how they feel about their jobs, how they feel about inflation, how they feel about their financial house, a lot of those folks are responding at crisis levels, meaning they don't feel good at all. However, when we look at the hard data, it's not that bad, and it's not quite signaling a recession is on the horizon. So we've talked about credit spreads in our blog, on these video series. And what we've done here is stacked up every major S&P decline over the past 30 years. You can see that right here in this left column in the various dates. This is our current episode, down about 21%. If the market decline was accompanied by a recession, you can see that here, and there's a question mark in this latest episode because we don't know, and the various levels of credit spread. Okay, so credit spreads, just to refresh your memory, are essentially a measure of stress in the economy. It's a measure of how accessible capital is to lower quality companies. So the higher these numbers, the less accessible capital is to lower quality businesses. So you can see, looking back at the financial crisis, October 2007 to March 2009, peak to trough, the S&P was down about 60%. Of course, that was accompanied by a recession. Credit spreads were over 2,000. Again, going back to COVID, S&P down about 35%, accompanied by a brief recession. Credit spreads blew out over 1,000. Same thing with the tech bubble, 2000 to 2002. So there's a theme here. Market declining more than 20%, credit spreads blowing out over 1,000, and a recession. 1,100, 2,100, over 1,000, recession. We're not quite there yet. Credit spreads during this latest episode thus far have peaked around 460. They've since gone down. They're right around 370 as of this recording. So if recent history is a guide, we would need to see credit spreads blow out a bit more. I'm not saying that this is the peak for this cycle, but so far the peak has been 460. We're back down in the mid threes, let's call it. And we aren't even close to a recessionary spread of over 1,000. So soft data screaming recession, hard data not quite there yet, but it is fluid. Things can change quickly. Things can change in one tweet. But again, looking at the fundamentals, looking at our signals, this is one of our rules, not quite in red flag territory yet. This is some of the soft data that I alluded to, and this is actually a pretty good contrarian signal, and I'll explain what this is. Going back to the survey data that I alluded to, this is a survey of folks that think stock prices are going to go down over the next 12 months. And that is at a cycle high of about 50%. So of the 50% of folks surveyed, they think the market will be lower 12 months from now. What's interesting about that And you can see the survey data going back, let's call it 1990, along with what the S&P 500 has done at various survey levels. Going back over the past 20 or so years, these inflection points have been a contrarian signal, and I'll show you what I mean. So let's go back to the financial crisis, right? Stocks cratered, and you can see during that time, about 55% of folks thought stock prices would be lower a year forward. An interesting thing happened. Stock prices actually bottomed at this survey cycle peak. You can see from 2008 onward, that was really a massive rally for the S&P 500. Going forward to 2011, we had the debt ceiling debate. Most people don't even remember that now, but U.S. credit rating was downgraded. A lot of people thought things would get worse. They thought stock prices would be lower. Massive rally ensued. Going back to COVID, at peak COVID, this basically marked the bottom, as you could see here. Many folks thought stock prices would be lower a year from here. They rallied much higher. Same thing is going on now. We've got this dip. A lot of folks are worked up with what's going on with the federal government. Half the folks think stock prices are going to be lower. I mean, again, you can't set your watch to this, but if I'm placing a bet, I would bet this is a contrarian signal. And it works the other way too. So heading into 2025, a lot of folks were really giddy about US stocks, big tech stocks. We wrote a blog that a reason for caution was most folks heading into 2025 thought the S&P would be higher 12 months from now. And you can see that this is at a cycle low. And sure enough, when folks are euphoric, they think it's all clear. Stock prices posted a really good 2023 and 2024. You get this dip here to start 2025. So this works in both ways. Right now, folks are overwhelmingly bearish. The survey data, the soft data, is consistent with a financial crisis. Think COVID, think 2008. And when you zoom out, again, the S&P is down by 6%, but folks are mixing investing and politics. They're staring at their phones. They're seeking opinions that confirm their own opinion, their own biases, and it stacks up to some of this crisis level soft survey data. Checking in on the Mag 7, the big tech stocks, you can see we've got those listed here at the bottom axis. The blue bars are what happened in 2024 versus year-to-date 2025. This is through 4/7/2025. And you can see this is about a week old or a week and a half old, but the story still holds that these stocks have been a great place to be really over the past 10 years, but especially the last few years. A lot of folks have made a lot of money. A lot of these blue bars reflect that. And this is just the other side of it. This ugly downdraft marked by the red bars, this is the other side of it. So we own a lot of these stocks. I personally own a lot of these stocks. Even if you own the S&P 500 or an ETF that captures US large cap stocks, you probably own a lot of these stocks. And we're saying they've been great places to be, but we'd be mindful about over-owning them, getting over your skis with risk, because you can't enjoy these beautiful blue bars without the occasional drawdowns. And these drawdowns tend to be ugly. This is not an outlier. This is not a glitch in the system. If you go back and look at drawdowns for these various big tech stocks, this is not unusual. If you go back 20 years, many of these stocks have experienced drawdowns worse than this. It's just the cost of admission of owning some of these high-flying names. So for folks that want to own these, that's great. We would manage the position sizing, but also know that some of these ugly, crooked numbers are part of owning some of these high-flying stocks. Let's talk about the US dollar. I'm fielding, I don't want to say nonsensical, but some questions that I can tell folks have been reading mainstream media. And when you zoom out, when you look at what's actually happening, some of these narratives are just absurd. And I think a hedge fund manager came out and recently said, it's gotten so bad with financial media and mainstream media. Basically, anything that you hear on there, 100%, it doesn't matter. It doesn't matter to markets. I'm not willing to go that far, but I'm going in that direction. And this is another example of that, where a lot of media outlets are reporting, the death of the US dollar. This is something that flares up, once every other year. It's been a common theme for like 70 years. Death of US treasuries. Foreign investors are shunning the dollar, shunning US treasuries. This is a 15 to 18-year look at the US dollar. This is an ETF that tracks the US dollar versus the Japanese yen, the Canadian dollar, the Mexican peso, the Swiss franc, the euro, many other prominent global currencies. And sure, recently the dollar has sold off modestly, but going back 15 years, the dollar is still quite strong relative to a basket of global currencies. The death of the dollar is egregiously overstated. The dollar as a percentage of global trade has been very steady over the past 20 years. Sometimes I think people get confused. Countries really don't trade with each other. Sure, there's a small subset with defense, maybe sensitive chips, but businesses, private and public, trade with each other. Those businesses employ rational people that trade with each other. Governments don't really trade with each other. If a business, private or public, deems it's good for them to trade with the US, to trade with the Euro zone, that's what they're going to do. So rational, free market individuals are trading. Governments trade, but not nearly as much as private and public businesses. Private and public businesses across the world overwhelmingly want to sell to the US consumer. The US consumer is the biggest juggernaut in the world. We buy more stuff than anybody else in the world. Countries, companies want to sell to the US consumer. In order to sell to the US consumer, you have to transact in US dollars. So when you look at the percent of global trade, US dollars have been very, very steady. Okay, so don't fall for these narratives that people are shunning bonds, people are shunning dollars. When the stuff hits the fan, people want to own US dollars, they want to own US assets. In order to sell to the US consumer, you have to transact in dollars. Okay, US treasuries, both short, intermediate, and long-term, are positive on the year. If people were shunning dollars and treasuries, you would expect those to be deeply negative on the year. That is not the case. So take what you see on TV, on mainstream media with a grain of salt. It is massively sensationalized to get you to feel worse, to panic, to do something, to sell assets, to abandon your long-term investment plan. Do not fall for it. You need to create a tight information filter. Be mindful of where you get information, because none of the information that's online is designed to promote good investor outcomes. It's designed to keep you watching. So there you have it. It's been a wild month. But again, when you zoom out, you look at some of the metrics, when you separate the soft and the hard data, when you look at S&P returns, it's been a wild journey, but it's really not all that bad. It's certainly not at crisis levels. So this is a really good opportunity to kick the tires on risk, to look at your portfolio, to get a second opinion on your portfolio, because you don't really get feedback in a bull market. When things are going up, you could be taking too much risk and you wouldn't even know it. When the tide goes out, you really see where the risk is in your portfolio. So if you have any questions about the way Pure Portfolios makes investment decisions, our investment framework, shoot us a note at insight@pureportfolios.com. Thanks for watching. We'll see you next month.